Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow. I want to welcome you to our second quarter call. Hope you get some information that'll help you today. There's some things we'll look at though, just so you know, is we're really going to look at the next 3 months on the economy, and the question is, are we in a recession? Are we going into a recession? And what impact that would have. Secondly, we'll talk about interest rates in the bond market, and we'll talk really about what's going on in the stock market. It's obviously been a tough year. And lastly, we'll actually talk about where we go from here and give you some thoughts on what we're thinking about the next 3 to 6 months. So if you look at the economy, one of the things that happened this past week is we went to a negative number on new orders on Purchasing Managers Index. Now this is usually a precursor to a much slowing economy. We see that starting to come into play. And we're seeing a lot of different things. This is just one. But if you look at soft commodities and some of the metals, you'll see that they're all falling down from where they were at their peaks. We think that also is an indicator that things are slowing down. And you'll see in the Financial Conditions Index, and this is really an actually very important index. It's probably one of the most important for some of the people that really look at what's going to happen. There's 5 or 6 indicators in here that really give you an idea of what's going on in the financial side. But when it's negative like this, you want to wake up because it's telling you some things that are going on out there. One of the things we've been hearing, and we hear it on TV, we hear it on the internet, is that the consumer's in great shape. He's still strong, she's still strong. Not true. They actually don't have as much savings as they had in 2019, prior to the pandemic. And secondly, the reason they've been spending money, if you'll look at the red line here, is because they've been borrowing money on their credit cards, which is not the greatest way to keep an economy going. So what are consumers doing? Well, if you look at this latest poll, 45% of the people in the poll are saying that their biggest travel hurdle this summer is not gasoline, but it's money. They don't have the money to take a vacation. And so we're starting to see that really impact what's going on. The second thing in the economy, and we wrote about this in the market letter, that this would probably be the Achilles heel of this whole thing, is real estate listings have really gone a lot higher. They're starting to show up, and you're starting to see some numbers really come out now year to year where sales, existing home sales, new home sales, listings, everything's changing in that category. It's nothing like it was 8 or 9, 10 months ago. The second thing, and I put this in there just so you could see it, if you took the median home price between 2018 and now, you'll see it's gone from $253,000 to about $383,000, meaning that your 10% down payment, and that would be the best you could do, a 10%, if not 20%, would be a 54% increase in 48 months. Secondly, with the interest rates going higher, you'll see that your mortgage payment, because of that, has gone up 111%. And so that's having an impact on that market as well. We have to keep that in mind. That's part of what's happening here. In the commercial side, and I wanted to use this graph from Green Street, you'll see where cap rates now have come under debt rates. And when that happens, that's going to give you some trouble. And we see that starting to happen. We see people pulling off of deals. We see them getting close to closing and saying, you know, I think I may wait on that for a while. We've seen a lot of that over the last 30 to 45 days. So where does that leave us in the bond market? One of the things I wanted to show you here, and these are not typos, by the way, this is a one-year comparison just a year ago to where these rates were. You'll see a floating rate treasury and a 3-month and a 6-month and a 1-year, 2-year, 5-year. Look at the numbers on those differences in that 1-year period. And this is where the Federal Reserve can really throw you off. They will tell you that everything's okay and everything's great, we're not going to do anything, and then a year later they've blown these rates up like crazy. One of the things I wanted you to notice, and this is an interesting 45-year graph going back to 1977, and look at the times when the market was down for the bond market for the year. Now this year it's down almost 12%. And if you look at other periods, okay, there's only one other period, 94 was down 2+. But this has been a rugged year in the bond market, probably more than people expect. One of the places we're saying, though, that you can park some money, and we parked a lot of it in there, is in these short treasuries. If you look at the 6-month, 1-year, 2-year, and as I speak today, they're all just very close to this. They're within maybe one tick of where these are. So there's still really some places to park money and not worry about it, really. And we're using a lot of this technique in what we're doing right now. On the stock side, and I said this really 18 months ago, this is Kathy Wood of the ARC Fund. And this was interesting. This was a May 2021 cover on Business Week, Bloomberg Business Week, where they basically said that you will be begging her to take your money because things are going to be so great and the fantastic future is going to be so great. And I compare this, by the way, for any of you that were around in 99 and 2000 to the Munder Net Fund. If you don't know anything about it, go look it up. Same situation here. So this is down 75% since January of 21. That's a lot. And interestingly enough, in the last 90 days, they've actually had people put more money into it. That's after losing so much money. But 75% is a hard hole to dig out of. One of the things that we noticed this time around that's never been around before, in our opinion, is the age groups of the people in the business. You see, we started in 2009 and 10, so we went through an 11 or 12-year period where none of the young people had a chance to ever really witness a true bear market. So if you see in this graph right here, people 20 to 40 years old, that's 52% of the people in the industry. Well, you know, if I'm 35 years old today, you think about that. I was 23 or 24 years old. I've never been through anything yet. I went through a 30-day down market in March of 2020. So they're not really prepared for that. And this is what it looks like. In a true bear market, you'll notice the red line. This is what happens. They go down, they rally up because you have people that haven't been through these before. Then they go lower and they say, this has to be the low this time, we'll catch it. Goes again. Then they go lower and you just keep on going till you finally get to a point to where everybody is completely disgusted. We're not there yet, actually. And so one of the things I noticed is pull this out through June 15th, and if you'll just look at these indexes, okay, and this did not include, by the way, the NASDAQ, which was down 30%. But if you look at this and all the major mutual funds, which we included in the market letter that are down some 26% or so, growth funds, there's some damage out there. And that's what people need to keep in mind right now. And so I couldn't get away with this without at least showing the graph on Bitcoin that's been going on, because that's really all we heard for about a year and a half was you don't know what you're talking about in cryptos. They're the greatest invention, you know, of your lifetime. Well, at this stage, if you go in and look at the 9,800 or 9,900 cryptos, the average down is probably 60 or 70%. And the ones on the low end are down 90%. A lot of wealth has been lost in that, over $2 trillion. So what happens in a bear market? And one of the things we try to get over to you is like, we are not going to sidestep it completely. There's no holy grail will get you through a bear market where you're going to be plus every single linear year. That does not happen. Here's what you want to do, though. You want to control risk. Okay, if you can control risk and keep that risk between 5% and say 15 or 20, even if the markets are down 50% or more, you have a really great chance of keeping yourself alive and surviving through. Look at what happened. The two last bear markets were '03 and '09, how much they went down and had the length of time. And let me give you an example. In 2008, in the summer of 2008, never will forget this, everybody thought we were going to have a soft landing. Had $140 oil. Everybody was like, you know what, they got this thing under control. And that was right before it started getting crushed and he went into the recession. Similar to today, everybody's optimistic, they're going to have a soft landing, Fed's got it under control. But if you look at what happens in two scenarios, okay, one is where you lose 50%, okay, you lose 50% of your assets, you take 100% to get break even. Now that's going to take you a long time. You're not going to get a 100% move in the market. If you could keep that to 10 to 20% though, and I use 20 here, you only have to get a 25% move, and over the next couple of years you can get that. That's the difference in controlling risk and just letting it all ride through, as Wall Street would tell you, just stay in it, you'll be fine in the long run. Well, actually, that's not true. When you get down this far, it's hard and takes a long time to come back. So in summary, where are we right now? We still have very high liquidity. We have the highest liquidity that we've had in a long time, almost 20 years actually, going back to 2000, I should say. And we're keeping it that way for the time being. I think the big question for us right here is, are we in the midst of a recession or are we going into recession? Because if we are going into more recession, this stock market right now is not set for it. It does not show that we're going into recession, because that means your earnings of public companies are going to go down, your multiples will go way down. That's what happens. On the maturity side, we're short maturities in the bond market. By the way, we do have some long maturities, don't get me wrong. But that's limited to 8 to 10%. Most of it's short, but if we see that we are going to drift into this really slower economic time, you're going to see us stretch those maturities and move them further out, because you want to get that yield locked in at that point in time. That's what we're watching. That's a big ticket right now. That's what we're really watching closely to see where we are. If we are going into a harder recession here though, and we could very well be doing that, you're going to see these markets go lower and longer. I don't think anybody's set for that. I think this entire investment world right now is saying, you know what, I think this is it. I think I've found the bottom. I think the Fed's got it under control. They'll come back in, they'll shorten the rate, everything will be good again. But they could be up against the wall on this inflation side. It could be worse than people expect. So our advice to you is to be patient in here. I have to say that our Oxbow 3 strategies actually have done well through this period. We're well ahead of any of these numbers up here. And I say that because, not because we're geniuses, but because we have a lot of liquidity, so it's kept us out of the areas where you get the most damage. So I hope this gives you an idea about what we'll be looking at over the next 3 to 6 months. But if you want more information about that, certainly come and visit us at oxbowadvisors.com or call us. We'll be glad to visit with you. Thanks.